but it wasn't the problem in the first place. And it actually increases the deficits, which are actually the source of inflation. So interest rates don't have that quite as clear relationship with controlling inflation as we associate them with back in the 70s and 80s. And so that's part of the reason I expect these deficits to be structural, is that the Fed's kind of stuck in a no-win situation where if they keep rates high, it means the deficit keeps blowing out even more, which eventually can be inflationary again. And if they cut rates, then they can weaken the dollar. They can emerging markets can get a little bit of a boom because their dollar-denominated debt weakens. They can increase their energy consumption and other things like that, and then you can get more inflationary pressures. And so either way, this is, I think, a background issue that they're going to deal with for years.
Okay. All right. So, Lyn, given the law of diminishing returns for money printing, do you expect the Fed to continue printing money in the future, meaning when they deem it necessary, despite the potential risks, or will they avoid further inflation by limiting money creation and accepting the potential economic consequences when they're faced with them?
I think that they're going to like Costco. Costco is trading at like over 50 times earnings.
Yeah.
And people said, "Well, I want to own that because it's bulletproof. I want to own Costco." So all the money's kind of piled into these kind of mega cap, low earnings volatility types of names, as well as an AI enthusiasm on top of that for companies like Nvidia. And I think that got overdone. I think we've seen some rotation out of that. I think there's a lot of profit taking, which I think makes sense. These things tend to go through capex cycles and get overdone for a period of time. One of the challenges with Nvidia is that they're making a lot of money, but all the companies buying GPUs are not really profitable yet. Like they're providing services and losing money, trying to figure out what their business model is going to be in this pretty rapidly evolving period. So I think that we could go through a period of consolidation where people have to kind of say, well, wait, I mean, should we be buying this many GPUs, or are we gonna have to increase the cost of our services, which might slow down the demand for those services in order to try to break even a little bit better. And I think one of the more interesting beneficiaries of the cycle could be emerging markets. Generally speaking, any sort of Fed rate cutting cycle is a window where they can do pretty well. The 2019 cycle was last year well. If you look at that emerging market recession analog, often you'll say, well, what are equity prices doing in local currency terms? They're going up. Well, what are they doing in dollar or gold terms? Usually going down. And if it's the dollar itself going through a similar situation, I think, for example, equities probably underperform gold over the next 3 to 5 years. Or at least even if they do outperform, I don't think it'd be by much. Basically, I think that just there's already evidence that equities are rolling over in gold terms. So we'll see how much legs that has to it. But I think that nominally, my guess would be not great returns and chop along and just kind of be uninteresting. And that depends on what sector you're in.
Sounds a lot like the 60s into the 70s.
Yeah.
Let's stay on the gold theme for a moment here. In your analysis, why would central banks ultimately buy record amounts of gold instead of buying treasury bonds at a 4% yield or whatever it was? What is that shift really saying to us?
Well, one is that if you just don't want someone to be able to press a button and your assets you're now long basing period, so it got a lot of capital interested, and so I expect, one of my concerns is that right now gold's a little bit overbought and the dollar's a little bit oversold.
Mm-hmm.
So I wouldn't be surprised to see some consolidation. But I'm not really trading around that view, because I think when we look back 5 years from now, I expect gold to be higher. And so that's an asset that I want to keep exposure to. And instead, I just kind of manage my expectations around this. But I do think we're seeing that little bit of rotation where, there were some buyers that kind of started the rally and then other buyers that have added to the rally, but there's still not any sort of like broad scale over enthusiasm. I would say there's still not, like, on the financial networks, there's not a lot of gold enthusiasm.
Right.
I was around in 2011 when gold had its prior big multi-year top, and back then, I mean, gold was like all over the place on financial media,
Mm-hmm.
and we're not really replicating that type of extreme environment yet.
Yeah. So, Lynn, I know that your profit margins and a potential for significant upside in your analysis are gold mining equities an attractive investment opportunity right now?
I think so. I generally leave them to experts. I have a handful, but I have a smaller allocation than I have, generally speaking, compared to gold itself. Kind of my approach with commodities is that for high stock to flow ratio commodities like gold and uranium, I generally prefer to hold the underlying one way or another. Whereas for things like oil and gas, I generally prefer to hold the producers rather than the underlying. But for gold, I also do own some of the streamers and some of the miners, or ETFs thereof, both individual stocks and ETFs. The performance has been disappointing in recent years.
Mm-hmm.
Obviously, back in 2022, the big increase in energy costs was a problem. You know, if you're
Mm-hmm.
one of your major expenses, directly and indirectly, is oil and gas, even things like tires for these big vehicles. Um,
Yeah.
the supply side is tight. They're not producing as much as used, so they're taking supply out of secondary market. Basically, former military uses is over
Mm-hmm.
time, decades of that has been repurposed to civilian usage. Um, that market is kind of opaque. People don't really know when that gets like acute, when there's just not really the tonnage. That's why uranium sometimes has these crazy vertical spikes, because you have very price insensitive buyers that just have to buy at any price because they have a $1 billion facility that
They're not
you
shutting
know
that down.
they're not shutting that down. Um, right now we're seeing we're seeing Germany, they shut off their nuclear plants. The US, we don't really see much growth, but when you look at the BRICS countries, they're moving forward with
Mm-hmm.
energy. And I spent the summer in Egypt. I go there every year, and they have acute energy shortages, electricity shortages. They're rolling brownouts.
Sophisticated investors through leading experts adept at navigating today's intricate market dynamics. So go check out the Naples Symposium. The link is in the comment section below. Lynn, let's discuss portfolio positioning. Understand that you're not a financial advisor. And based on all we've discussed today, and with your experience and your worldview as the backdrop, how are you positioning for the next 12 months? I know you said gold and I know you said uranium. What other assets do you like, and what assets do you absolutely want to stay away from?
I generally like emerging markets and Bitcoin here as, slice of a portfolio. Generally you have to mitigate their volatility to whatever makes sense for your portfolio needs, but I do like them as part of that portfolio for the next 12 months. Kind of more structurally, my approach right now and for a while is a three-pillar approach. So instead of the 60/40 stock bond approach, which is really geared toward expecting because I'm involved in the Bitcoin space, I'm willing to weight that a little bit higher than what you would typically recommend in someone's portfolio. So everyone has to kind of tweak that to what they're expecting their portfolio to do.
Understandable. Well, Lynn, thank you for coming on to Metals and Miners and for being so generous with your time and analysis and your ideas. It's been wonderful to spend this time with you. Would you please share with the viewers any important message that you want to leave with those tuning in, where they could learn more about your work and how they can connect with you?
Sure. People can check out lyndalden.com. That's where most of my research is. And I'm also available. You can buy my book, Broken Money, either on Amazon or elsewhere. And I think the main thing I would leave people with is that, um, I think this is a really good time to think strategically rather than tactically, which is to say, what do I think the next 5 years are roughly going to look like? And what are the different scenarios that could play out that surprise me? And how do I want to position to do reasonably well in most of those scenarios? Maybe more so than just, what's going to happen in 3 months.